Okay, good morning and welcome to today's Tuesday Markets Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the current market. Now, we have literally just had CPI data coming out in the last few seconds, a small upside surprise. And looking at futures right now, the real-time impact, we are seeing a pre-market bearish move here. So it does look like those slightly higher numbers for the inflation numbers, the CPI data, that could have a negative impact here for equities, but I think it also comes at the right time. So I'll tell you what I mean when we're going over the charts. But before we get started, we should just take a look at the disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video does not include, is not intended to be used for individual tax, legal, or investment planning advice. Sorry, I'm just distracted here looking at the CPI stuff. But our agenda for today, kicking off with the major equity indices, we're going to see where price could potentially pull back to from all-time highs, especially with now CPI data acting as a bearish catalyst. From there, moving on to fixed income and commodities, we'll take a look at the sector rotational model as well, highlighting which sectors are outperforming and underperforming the broader markets. Take a look at a few subsectors of interest from the last few weeks, and we'll end today's webinar with some bullish and bearish market observations. So just to give you an update on the CPI numbers, month on month, for the core CPI figure came 0.1% higher, and 0.4 was the actual figure when the forecasted figure was 0.3. CPI for year on year for January, forecasted figure 2.9, coming out at 3.1%. So that's a bit of a 0.2% upside surprise there, which I could see why equities are pulling back as much. But when I look at the chart as well, we have on the daily time frame, price did touch all-time high territory yesterday once again, and it did reject that level. It closed at around just above 500. It's going to open a bit further lower than what the screenshot shows. So overall, I do think it was a good time for a pullback anyway, because we had momentum approaching somewhat of an overbought condition, a little bit overextended on the rally, and the risk on sentiment remains. I think what this CPI figure tells us is that there is going to be pretty much no chance of a March interest rate cut. During December and November last year, we were seeing markets pricing that in, hence the big Santa Claus rally. But now it doesn't look like that's going to happen. We have still seen equities continue to move higher due to, one, a pretty good earnings season, but also the AI boom kind of continuing this momentum. However, it does now look like price will pull back, which could also still be a good potential bullish opportunity in the future. So in terms of the areas the price could pull back to, keep an eye out for 490. That's a potential level of support, or just above that 480 level. Yeah, I would say in and around 480, because that was a previous resistance zone and just about a support zone as well. But yeah, keep an eye out for prices to be moving lower throughout the day. Right, the Nasdaq 100, looking at the cues, we have, again, what's probably going to be a pullback here. Let me check the pre-market level. Yeah, set to open at around just below 429. So that's going to be, quite a significant move for the open. Next key area of support sits below 420. I don't know, let's say 415, that was a previous swing level for resistance and some support. But also, I am seeing potential signs of negative divergence. I wouldn't read too much into that. Yes, when price makes a higher high and momentum fails to make a higher high, that can be a bearish indicator. But at the same time, what's causing this rally is very fundamentally and macro driven. Markets are pricing in the fact that we are going to be cutting interest rates throughout the year. And that is why we're going to see, in the longer term, the bullish sentiment should continue. However, in the short term, especially with today's data, we can see just how volatile it can be. And I do fully expect, a good bit of a pullback here, back towards that 415 to 420 area. Okay, so small caps, looking at IWM, the Russell 2000 ETF. Uh, I'm seeing some outperformance here in the last few days. Price did respect the 188 level that we have spoken about now for a few weeks, the 38.2 fib. Uh, Initially looked like it was going to break out, but actually came back, retested 192, and now we're seeing plenty of momentum. Taking a look at that momentum chart there at the bottom, you can see the blue lines on the 50-period CCI moving with a lot of momentum, heading with price heading now towards the previous swing level at around 204. But the next key level that I am looking at to the upside is 210, which is a 23.6 fib level. From there, you're looking back into this range between 210 and the 235 area. But small caps showing some good performance, especially after a period of underperformance relative to large caps. Okay, TLT, the Treasury Bond ETF, we do have some support just below 93. Price so far is respecting that. Just taking a look now at the chart here. Yeah, okay, it looks like it's going to break below. It's going to open below this level of support. 92.70 is where the pre-market currently is. So it looks like, again, this inflation number has been a bearish catalyst here. Most likely yields are going to be elevated now for longer, and that is obviously going to have a negative impact here for the bond ETFs. So breakdown of this level, bullish structure, in my opinion, still remains intact. We could get a bit more, a smaller decline, but keep in mind that, throughout the year, TLT should rally because of the fact that the Fed will eventually cut interest rates. It may not happen in March, or almost most likely won't happen in March. But once we get through that, the big question is, will it happen in the next meeting? So for TLT and the bond ETFs, I do expect to see a short-term decline. All right, moving on to the US dollar. So the US dollar, I'd say it's probably going to rally from here. Yep, it's at 104.60. So price already, at around this level here, just after this news. And that's a pretty significant rally already. Yeah, sorry, I'm actually just thinking what I could do is this might make a bit more sense for today, guys. Just given that the screenshots don't really mean much when you have an announcement that happens on the minute that we start the webinar. So here we have the US dollar index. You can see just how much of a difference it was in the last few minutes. I took that screenshot only a few minutes before the news came out, but we can see the price is now rallying, breaking above 105.50. This definitely puts the upside area at around the 105.50 upside area in the next few days. That could be a good target here for the US dollar. And overall, even though I do expect yields to decline throughout the year, we are seeing some short-term momentum. Let's see how long that'll last. Okay, moving on to gold. Gold still quite neutral. Price set to open a little bit lower. And with the stronger US dollar, we could very well see a proper break below this trend line. And price seeking further support, probably at around 184 is what I'm looking at. So a limited move to the downside, but gold has been in this tight range, very choppy for quite some time. Now that we have some indication as to where yields, the US dollar and bonds are heading, we could very well see gold now break down and start to move slightly lower. Momentum has been negative the last couple of days, so my bias here is to the downside. I'm looking for that shorter move towards 184. And price has not been able to once again break above this major multi-year resistance zone, despite the fact that it has consolidated just below that level. Okay, moving on to oil. We get light crude oil futures. Oil not too phased by this news this morning. We have seen a lot of choppy price action followed by what was essentially a false breakout, an immediate decline lower, and now a bounce higher here. So price is definitely acting less choppy, which makes it a little bit easier to trade, especially if you're looking to trade energy companies that have a high correlation to oil prices. But keep in mind, there is a resistance zone at around 77, 78. That area price has failed to break above, and it's, really since November last year, there's been multiple retests of that level and price has failed. And right now, price is once again at that area. So if we look at bearish price, if we see some bearish price action, that could justify a short entry and potentially a retest towards the low 70s. Right. Taking a look at sector rotation, we have 6 sectors in the improving and leading categories. We have 5 in the lagging and weakening categories. Actually, nothing in the leading categories, but the 2 sectors that were in the leading categories for quite some time was communications and technology, both showing some outward rotation. I'm not too concerned about that, especially for technology. I think this is good news because it indicates that the current rally that we are experiencing has broad participation. All the other sectors are actually participating in this rally, unlike what we had during the pandemic recovery period where interest rates were low and it was only the technology sector providing leadership for really around 8 months before the other sectors started to gain some traction. Right now, we are experiencing broader leadership, which is good. But I do also expect technology to get back into the leading category quite soon. This news could potentially see the tech sector especially be negatively affected because technology does have a higher sensitivity towards interest rates. But we are in the middle of an AI boom, and we are in the middle of what is still very much a risk on sentiment. So that short-term volatility that we experience with technology, I don't expect it to last that long. And the fundamentals or the longer-term fundamentals and macro picture still point to technology recovering and once again providing some leadership. Now, our defensive sectors, we have utilities there in the lagging category. We have staples as well in the improving category, but should be in the lagging category by tomorrow. Well, it depends. We could see price start to outperform as investors rotate back into the more defensive stocks. As you can see, pre-market staples is holding quite firm. Technology, big gap lower here. Yeah, so that's pretty much expected after today's announcement. We do have some support at 197 for technology, 193 as well. So those will be the 2 areas to the downside. But take a look at this negative divergence. Momentum indicators showing a lower high when price made a higher high. So this could very well actually turn out to be some capitulation if we only look at the technicals. Fundamentally, though, I don't really think that'll happen. I think that we should actually, see maybe some consolidation for the next few weeks, but the bullish structure should still remain strong, in my opinion. All right. In the improving category, we have discretionary performing quite well. We do have some retail sales numbers coming out on Thursday, so that could have a negative impact on discretionary. Price is set to open a good bit lower this morning, but it does have some support at 173. So after that initial breakout, that's been quite short-lived. And there is still potential upside, a lot of potential upside here, back to all-time highs. So look for these declines as potential buying opportunities, in my opinion, because again, all-time highs sitting at 210, the risk to reward does favor the upside. All right, moving on to some subsectors of interest. Let's look at DRIV, which was our bearish play from last week. And this has not turned out well. We were bearish, initially when prices at around 22, 23. And so it was going well with our thesis initially, but then we had this big move to the upside, breaking above the 23.50 level and thus invalidating our thesis last week. So that would be a good time to close this trade and cut losses, unfortunately. If anything, this looks quite bullish, given the fact that it's broken above that resistance zone. It may pull back, and from there, it could potentially move higher. But DRIV, unfortunately, a trade that did not work well for us. Moving on to the biotechnology ETF, IBB. Price is actually still within our thesis, staying above 133, which is good. This is more of a credit spread idea, so it will still be profitable even at this level. However, it is showing a lack of upside momentum. The biotech sector is also, as much as it's part of the healthcare sector, it is also a higher beta sector, and a more hawkish Fed would have a negative impact here for IBB. more so than the broader healthcare sector. So this might be a trade that you want to take profits on now and reduce that risk essentially, or eliminate that risk. Moving on to some market observations, we have Oracle. Oracle was a longer term bullish play. We've been bullish on this for weeks, and price is kind of topping out at around 118. Not exactly showing a lot of bearish price action, but for now, I'm going to keep this open because there's still a big gap up high towards 126. Also, Oracle's a legacy technology name, so a hawkish Fed would have less of an impact than it would for the more higher growth companies that carry more inherent risk. Oracle isn't really one of those companies, even though it is part of the technology sector, which is considered a growth sector. And I think it's one of the safer bets to place in the technology space. Okay, taking a look at lows, which actually had a nice breakout. We've been bullish above 210. Price initially moved in our favor, came back to retest, and then did bounce up higher with a lot of momentum, breaking above multiple resistance zones, especially the 225 area, which was quite significant, but set to lose those gains this morning with price set to open at 225. So now would be a good time to get out of this trade. Again, this was a more of a credit spread idea, but we did have a good move in our favor. It doesn't look like price will be reaching the next swing level at 235, given the CPI data coming out today. All right. Moving on to a new idea, which is actually Newmont. Let's see how price is here. So Newmont this is a bit of a contradiction, I'll admit that, but I'm actually looking for a bullish play here in Newmont. Looking at the fundamentals, trading at 15 times its PE ratio, which is below its historical average. This is a gold miner name, so it does have a high, or used to have a high correlation with gold prices. Obviously, that hasn't really been the case for quite some time, but because it's so oversold, the risk reward does favor the upside. And we did initially get that bullish move yesterday, price moving lower this morning, which is again due to macro forces in play. But it's a trade that I'm going to keep open with a very tight stop loss. So if price breaks below and closes below 32.60, that's when you'd want to cut losses on this trade. But for now, I'm interested to see how it develops. And because I personally entered this trade yesterday, um, obviously you guys wouldn't have entered this trade, so maybe wait until after earnings or wait to see some bullish price action confirmation from this level. All right, moving on to C Limited. This was a bullish play. We were bullish with price at the 35 level of support. So far, so good. Last week was a good time to take partial profits, and price has continued to grind higher. The next key area would be at 45. Looking like it was heading towards that level, but again, after today's news, set to open a good bit lower. Now would be a good time as well to just exit that full position and really take what would be close to max profits for this trade. This was a trade that worked very well in our favor. We were simply playing the range. I don't necessarily expect price to break above that 45 level, but we haven't quite got there. And we already have, and because of the CPI print and price being at overbought condition, it just makes sense to close out this trade, in my opinion. All right, and then moving on from a new idea from last week, which was actually an earnings trade that was on. We were bullish last week, Tuesday, and Wednesday was the earnings announcement. So that's why, I spoke about this last week because, we had this very strong bullish trend, not so obvious on this chart right now because of how much of a big move it's made. But we had a nice pullback towards that $70 level, and price is bouncing on that level, forming a higher low ahead of earnings. So it pulled back just before earnings, but overall bullish structure. Given that this is a semiconductor name, also provided a nice, attractive earnings opportunity. And for those of you that did take this trade, all I can say is well done. I mean, look at where price went to even yesterday. It touched 160, so nearly or just over 100% gain from that Tuesday close. Very big mover from earnings, although set to open up a good bit lower this morning. No surprise there with momentum being heavily overbought and given the news from this morning. But yeah, very good earnings play for those of you that did go for it. All right, and with that, that is all I have time for today. Big thank you for all of you that joined, and I will see you next week, Tuesday, for another market outlook. Hope you all have a great trading week. Goodbye.